Hey guys.
Hey y'all, I'm in my car for today.
Hey Jacob. Just waiting for Tom to hop on.
Yeah, I've missed the last few of these, so I'm curious to see what the latest is.
He said he had quite a bit to go over, so that's
Oh, excellent.
yeah. We're having a little technical difficulty. Tom will be on in a minute.
Hello.
Hey, Tom.
Hey, it's working. Hey, I love technology.
Same.
Okay. Sorry I'm late. Wow, what a kind of a wild swing over the last several weeks. We had a really interesting thing happen when after the Feds raised rates, the bond market got much better, as did pricing. So the bond market got about 60 basis points better on pricing, and mortgage rates kind of followed suit, which was really interesting. The assumption being that was going to be the final big hit. And interestingly, we had another little swoon Thursday and Friday this week. So I don't think it's going to be the last big hit, because we've had some economic data come out today that is sort of pointing in the wrong direction. So we'll see. But rates are pretty good. They're actually in the mid to low sixes, depending on scores. So let me jump into that first. Let me show you that. Let me share my screen. I have a lot of stuff open. Hold on one second. Can you hear me?
Yeah, we can hear you.
Okay. First time I've used my Bluetooth on this particular computer, so I'm a little. Oh, where is it? There it is. Okay. Okay. So the other interesting thing that's happened is the Ginnie Mae bonds have started to come back a little bit more, so the spreads are starting to widen a little bit. They're still not where they should be, which is about 100 basis points better than conventional, but it's much better than they were, 3 or 4 months ago. So FHA and VA rates are in the mid to upper sixes. So the 660 and above range, you're at about 6.7 and change, 640, 6899, and so forth. The conventional rates, not including the Home Possible and Home Ready, the best rate we have right now is about 6.642, and it's jumped about almost 3/8 today because of that negative economic news. We were in the low. I was quoting 6.3 and change on Friday, so it's about 30 basis points higher. And we lost a little bit more in pricing because I was out at that 6.3. I was only charging like 3/8 of a point, so it's up quite a bit from a pricing perspective. Home Possible, Home Ready, remember those are the ones that make $94,200 or less. Regardless of credit scores above 620, the rates are all the same, and regardless of loan to value and property type. So that's running about 6.35, which is about a little more than a quarter worse than it was on Friday. And I wasn't charging any points on Friday. What else happened? Oh, the conventional loan limit increased by about, I don't know, 100,000. 80,000, I'm sorry, to 726.2. It's become official. We were actually working on a 715 number because UWM will give us a sort of a shot in the dark of what they think the rate of the new loan limit is going to be. We've had that for about a month, but now the FHFA came in and set the max loan limit at 726.2. So that's a big number. Huge. The other thing that I'm pretty sure I sent this to you guys, but FHFA also came out with first-time home buyers with pricing that matches exactly the Home Possible and Home Ready. So if you have somebody who's a first-time home buyer and they make less than or equal to the area median income, which here in Minnesota is about 120,000, they can qualify for the same rate here versus having to meet the 94,200. So it's about $17,000 a year difference if you're a first-time home buyer. So you can qualify a little bit better. What else is happening? I'm doing a lot, and I mean a lot of. I've got a lot of buyers interested in 3-2-1 buy downs. It's become a pretty good strategy. So since nobody's really getting full list, at least what I'm seeing, what I'm counseling people to do is to go in and offer list price, but then have the seller pay the 3-2-1 buy down. If you did that today, you could get rates in the threes, and 3-year free, like for example, the Home Possible be 3.375 today, and it'd be that for a year, and 4.375, and so on and so forth. The cost it can be relatively steep, but on a percentage basis, it's not that much. I mean, it's usually about 3 to 3.5%. So if you've got a list, if you got a property that you're offering list, that you're going in at list price, and it's been on the market for 2 weeks or better, it's very likely you're going to get that deal. You may even if they come back and renegotiate it up a little bit. I mean, that's a great deal. I'm doing a lot of those. So that's a incredibly popular product right now. And it's a pretty good strategy for helping your buyers get in at rates we were seeing a year ago. We won't see again for a couple of years, but I think my guess is we'll be refinancing these guys in 18 to 20 months. So mid 2024.
Makes sense.
What else? That's what I'm seeing right now. What are you guys seeing? What I'm seeing as far as the list price? I'm not seeing anybody get list price.
You guys see it?
Yeah, the last couple of deals I worked with my buyers, we got yeah, actually both of them were at list, but with pretty significant concessions, like to the tune of $20,000 of assessments being paid off, or yeah, big type of contributions. So yeah,
well,
in that
sense,
definitely.
That's exactly what I'm doing. I mean, so that 3-2-1 buy down, it's an awesome product. I mean, they're gonna. Some people think about this as, well, why wouldn't they just do a permanent rate buy down? Because you can't buy down the rate enough for the same financial benefit.
Right.
Okay, you're only going to buy down maybe a point and a half, but here you're talking about 3 full points. I mean, it's a massive savings. I did one the other day, $415,000 deal. The first year savings was almost $800 a month. So I mean, that's huge. Tack that on, for over a 3-year period. I mean, those are big numbers. So the eye towards refinancing, getting rates that we saw a year ago, it's huge. I would absolutely be talking to buyers about that.
Okay.
Tom, I've got a couple questions for you.
Okay.
The first one is, what's the spread now between the 10-year T-bill and mortgage rates? I know it's recently been much higher than usual, like about a 3%.
Exactly. It's been about 3, but it's only running about 2 and change right now.
That's narrowing a little bit.
Exactly. So right now it's about, I think the 10 years about right at 3.6. So you're probably looking at about 265 basis points. But it had been running 350 basis points all day. So typically it's only about a 2-point spread. So it is definitely narrowed.
Cool. And then I wanted to ask you, do you have limited income verification programs now?
We do. We have bank statement programs. We have, we actually have no doc, if you believe that. So, but you have to have, relatively decent credit and significant down payment. So 20% or more on those. Can
you do refinances with those?
It's rarely beneficial because the rates are in the, they're probably about 1.5 to 2 points higher than conventional.
Yeah. Yeah. What about cash out refinances?
Can do those, but the LTVs are limited typically to around the 65 to 70%.
Okay. Okay. And then I wanted to ask you, in terms of, you talked about you're kind of expecting people to refi, maybe mid 2024 and so forth. So obviously you're assuming, like I am, that, rates are going to come back down somewhat. So I watch this stuff. It's really hard to predict, of course, but, the Fed, I don't know, sometimes I think they're overdoing it, but, then you understand, they got to get inflation down and stuff. But a lot of things that I follow about the inflation numbers that they use, and particularly the core inflation that they to look at without, food and energy. And such a high percentage of what goes into that basket of goods is housing, particularly with the core inflation. And I heard like maybe 40% or more of that core inflation is housing. But the metrics that they use, the surveys that they use, I keep reading that they are very lagging in terms of, compared to other surveys that are out there that are much more current. But I think the Fed defends the use of the measures that they use in part because they believe they're much more complete, compared to the other surveys, which might just show, current rent for people that are looking, for an apartment right now. The Fed uses surveys they think are more complete that, would include renewals because most people aren't moving and so forth. But just wondering, because a lot of people are thinking that the housing inflation has really stopped, or slowed down dramatically, but the numbers that the Fed's using based on, the CPI figures and the core inflation, it seems to be still rising because it's lagging so many months.
It is lagging. The crazy thing about, the numbers that they use, I mean, it's they it's the old statistics thing. A trend is a trend is a trend. But unfortunately, they use a sledgehammer, and like you said, backwards facing data that isn't really on trend with the macro numbers. It's difficult. I mean, my personal feeling is I think they need to completely reimagine how they predict, the moves that they need to make, because everything is global, and I don't think they take the entire global economic picture into account. They're simply looking at the 4 or 5 different economic things that affect the U.S. economy. But we're not just an economy based in this country. We are so dramatically affected by what's going on in the entire world that I really believe that they need to completely reimagine how they do this thing. But that's just wishful thinking.
Yeah. Thank you. Well, hopefully the inflation numbers that they rely on start to slow down. And
well, the big one's coming out on the 13th. That's going to show us, CPI. That's their big number. And I'm just hoping that the consumer gets a hint and stops, spending money because
that comes out on the 13th.
13th, right? Yeah, that's the next big one. And it's the be all end all for the next, probably 6 months. So we'll see.
Yeah.
Right now they're still thinking 50 basis points, but I don't think 100 basis points is off the table. So we'll see if that number goes, just,
Yep.
much higher than what they're expecting. I think they could, like I said, bring the sledgehammer down once again. So we'll see.
Cool.
Yep. We shall see.
Mhm.
And I'm watching this, my monitor, my MBS live monitor, and it's just red. Gosh. I love our business sometimes, but yeah, we'll see. But I mean, honestly, rates are, one thing I think that the MBS market does a really good job of, they're pretty good at predicting. You're talking about, tens of billions, hundreds of billions of dollars being hedged. And those guys know what they're doing. And I believe that they have a better handle on the real trends. So to me, that's a positive sign, because we could have seen, I don't know, 60, 70 basis points move today, but we didn't. We saw 25 to 30. So we'll see.
Good. Thank you.
Mm-hmm.
Okay. Anything else we should know?
No, not really. As you can imagine, turn times are super quick. Want to close one in 2 weeks? We can do it.
Sounds good. Well,
Yeah.
thanks for your time today, Tom.
My pleasure. I will knock these rates out and shoot you an email with them.
Sounds good. Okay. See ya.
Yep.
Thanks,
Yep. Bye.